Dollar cost averaging is an investment strategy in which investors put a consistent cash flow into an investment. It is based on countering the typical investing strategy of buying low and selling high. In theory, it makes sense to purchase investments at their lowest point and sell them at their highest point. However, it is almost impossible to know when an investment's price has hit a maximum or a minimum. Knowing how to beat the market is an extremely difficult task. Most actively managed funds do not even beat their benchmark of the S&P 500 return. This is because no one can completely calculate the effects of market forces on prices in the future. Therefore, purchasing large amounts of stock at one price is dangerous. Dollar cost averaging attempts to get around this problem. Rather than take an entire lump sum of cash and purchase shares all at one price, dollar cost averaging is about purchasing investments at smaller increments over time. Let's first look at an example of traditional investing, and then at dollar cost averaging. Let's say a stock price is currently $10. An investor has $1,200 to invest, and they purchase 120 shares of the company. The next day, the price drops to $5, and the following day, the price is $12. At the end of these 3 days, the investor's money is worth $1,440. 120 shares times $12 per share. Now let's look at dollar cost averaging approach. Let's say the investor splits his money evenly and buys $400 worth of stock on each day. He buys 40 shares on one day, $400 at $10 per share is 40 shares. He buys 80 shares on day 2, $400 at $5 per share equals 80. And he buys about 33 shares on day 3. $400 at $12 per share equals about 33. At the end of the 3 days, the investor has 153 shares, which is equivalent to $1,836. Dollar cost averaging takes out the guesswork and stress of figuring out if you are buying at a dip or a peak. Odds are, when you invest, you are buying at some level in between. Rather than risk overpaying for an investment, dollar cost averaging allows you to capture long-term changes. Since dollar cost averaging involves purchasing shares at various prices, the hope with this strategy is that the overall prices will shift up in the long run, making the earlier shares more valuable. Through this method, investors do not need to beat themselves up for purchasing shares at high prices.